we on? I think we are on. Well, look, team, I came on to talk about this inflation, CPI. But just as you go on, breaking news comes out, and it looks like Sunak is finally calling for the general election. 4th of July. That doesn't seem very long away, does it? There we go. We'll see how that story develops. For now, in this video, I want to talk about what's going on with inflation. Today, we saw the latest inflation release. What's happened? Let's look big picture and have a think about how that's going to affect things going forward. So first of all, team, I am live. So if you are on the live, please make sure you can say, give me a thumbs up if you can see me and you can hear me. Find something in the comments, type it in. As always, we'll be asking questions throughout as we go through. If you're watching this on the replay, again, please put your comments in as we go through, right? It's fantastic to see everybody. I know I'm not on very regular these days, but ultimately I aim to come on when there's something to talk about, which of course there is today. So let's not labor, oh blimey, there's a pun, isn't there? Let's not labor this too much. Let's go and have a look at the CPI release. So headline is CPI has dropped a lot. I'm not going to go through all of it, right? We're pretty much to target. There's been a bit of a hoo-ha about, hasn't quite got to where the analysts, the economists said they thought it might go to 2.1%. I think, what's it at 2.3 or something like that. Look, the trend is down. If we look at the picture, if we look at the big picture with CPI, it's inflation, not CPI, inflation. It's very obvious to me, right? The trend is down significantly with CPI, CPIH, but look at that graph with the OOH, that's the owner-occupier housing cost. This thing I want to really focus on because really, we're all now looking towards interest rates. When are interest rates going to come down? Are they going to come down at the next meeting? Are they going to come down in August? Are they going to come down at all this year? Or, as the IMF said, are they going to come down considerably? IMF has suggested they should be about 3.5% by the end of next year, by the end of 2025. So, before we go forward, I'd love to know your thoughts on it. When do you feel is going to be the first interest rate cut? Do you think they're going to go at the next meeting in June, bearing in mind, July is June. Bearing in mind we have another CPI or another inflation release before now and then, or do you think it's going to be August, or do you think it's going to be later than that? And before we analyse where I think we're going to be with interest rates, just a quick overview if you're new to the channel. This is the channel where I look at objective data and try and get through the mainstream hyperbole that really paints a very confusing narrative, right? And talk about what's actually going on beneath the hood so we can make more informed decisions as investors, both in property or business, entrepreneurs, or if we're just buying houses. So please give me a thumbs up if you think that's something that would be useful for you. And please do subscribe to the channel because it helps me get reach to people who need it most. So let's talk about this graph, right? And I want to talk about that dark blue, the OOH. Now, CPI is pretty much on target, right? We're there or thereabouts. But what is obvious is this line is going stratospheric. And I want to ask why and what influences interest rates have on this. Now, OOH is owner-occupier housing cost. So this is the cost of owning and maintaining a house, right? This is separate to rents. So in the CPI basket or the CPIH basket, we've got both the OOH element and we've got the rental element. But here's the thing, right? OOH has multiple ways of calculating. It's actually got three separate ways of calculating OOH. And the one that's used in the CPI basket is called rental equivalency value. What does this mean? So it's impossible to tell what the price of a house or how much a house costs somebody to own because some people own it outright, some people will be on mortgages, lots of people will be on different interest rates, so therefore it's not a level playing field. So for the purposes of CPI or CPIH, what they do is they look at the equivalent rental value of that property, okay, if the owner who owns it was renting it. So that's how they kind of baseline what the OOH element of CPIH is. So when we look at this graph, we see this going up, which means effectively that the rental equivalency value is going up, which in turn means rents are going up. Now that is no surprise. If we scroll down, okay, to the graph of house and housing services in CPIH, I just want to find the main one, this one here. Okay, if I take out utilities, maintenance, repair, council tax, so we've just got rents and owner-occupier housing costs, we can see both of them are going up. Why are rents going up? There's multiple factors that are causing rents to go up. One, we have an exodus of landlords or a reduction of landlords in the private rental sector. because of a lack of stock, because of anti-landlord legislation, because of anti-landlord taxation when you look at Section 24. This has caused a net outflow of property owners or property investors and therefore landlords, creating a supply-demand imbalance, which therefore puts the rents up. What is compounded with this, okay, is with as all of these other things have come in, the interest rates have gone up. So a lot of landlords find themselves in a position where they are potentially on variable rate interest rates, or they've refixed on higher interest rates, and these costs are therefore passed to the tenant. So that causes the rent to go up. By definition, if owner-occupied housing cost is using the rental equivalency value, rents go up, so does OOH, right? So the two are really linked. They're kind of one and the same. Now, when we look at this graph, we can see, when we look at the main graph, we can see it's going up significantly. Now, why is it going up significantly now whilst the rest of CPI and CPIH is coming down? For me, this is because of lag in the system. Think about it like this. If somebody ties into potentially a 1 year tenancy or a 2 year tenancy, that rent is fixed for a certain period of time. It's not just a linear scale that every month, right, the rental values are going up or the OOH is going up for that individual. You're going to be on a level playing field or a level price, and then your tenancy comes up and then the landlord is going to put it up. Now, if you're going to stay in that property, what a lot of landlords will do is probably not put the rent up to keep you because it costs more to have voids. And so therefore, really, the rents are going to go up to the market value when a tenant moves out and a new tenant moves in. Now, some landlords, of course, might just put, at the end of a fixed period, put the rent up. So what does that mean? There's going to be lag in the system. I would say we're almost probably, a year, at least a year behind for this graph compared to the main CPI and CPIH graph. Also, when I look at this, it says to me there's an issue in our country. Okay, it says that we have a housing crisis going on because number one, there's a real lack of housing out there. There's a lack of rents. We know there's a lack of rents, and we know that supply-demand curve has meant that rental values have spiked up over the last couple of years. Like there's been significant rent inflation, rent price inflation, which is now feeding into the OOH costs. Now, is it going to come up or carry on going up forever? No, it's not. So what I see on this graph, I would say is different, okay, to what I'm seeing on the shop floor right now. For the last couple of months, it's felt like as a property entrepreneur, as a landlord, as somebody who rents myself, that the rental market is cooling off. I feel we've hit the top of that rental market in terms of price inflation because you kind of hit that limit of what people can afford. So I feel this graph here, right, is lagging behind. But also, this is directly related to interest rates. Interest rates going up forces these elements down, but effectively it's forcing or contributing to the force of this element going up. So, a lot of people are talking about OOH, owner-occupied housing. Without a doubt, it's there, right? Without a doubt, it's causing significant affordability to people. So we're now in a position where CPI and CPIH are pretty much, in target. Strip out the volatile stuff, and the core is still significantly above target, but the trend is coming down. And we've got high interest rates, trend of CPI coming down, trend of OOH and rental values going up, which is directly linked to interest rates. So the question is, how long are they going to keep these interest rates up there? Okay, which is compounding these issues for people. Personally, I feel they need to come down. Now, the bank are going to have some decisions to make because there's conflicting data going on. So number one, we can see a trend. Now, whether they've already said that they don't have to hit target, right, which is 2% before they reduce interest rates. The trend is clearly dropping off a cliff, although a lot of that is due to when you look at the rolling 12-month delta of the utility costs that feed into all of this. There is a perception or there is a hypothesis that it's going to go up again, sort of second half of this year. So we'll see if that happens. But the trend is clearly down. Now, when we talk about interest rates coming down, one of the big yardsticks and indicators that the banks seem to be using is the labour market. Okay, so let's go and have a look at the labour market and see what's going on here. Now, before I talk about any of these statistics, I want to caveat that they say at the beginning of this very clearly that the labour force survey is still very small data set, so therefore we need to take all of the data with a pinch of salt. Okay, so let's go through some of the main elements of this labour force survey because there is a mixed narrative. On the one hand, in the mainstream media, seeing a lot of people talk about unemployment coming up, right? Businesses really struggling. On the other hand, people are still talking about very strong wage growth. So I want to have a look at both of those. So let's start with job vacancies. We can see the continuation of drop of job vacancies on, which are out there. Now, what does this mean? Effectively, a lot of companies, rather than if you're not growing, if you're kind of just treading water while interest rates are high, and a lot of companies can't grow because they don't want to borrow because the interest rates are high, it's too expensive for them, and therefore there's a complete lack of growth, in our economy. Rather than firing people, if they're not going under, they don't need to fire people. They just stop recruiting from the bottom. So basically, you've got a labour force, right, that's kind of getting older, and rather than recruiting to, from within, also not from within, rather than recruiting from the bottom, people are just coming out the top. And rather than getting rid of people, they're getting rid of vacancies, right? So just not filling the vacancies rather than firing people. So that's why we see this continuation down in vacancies, which again is an indicator, right, that companies are struggling or they're not growing, they're not bringing more people in. I'm going to come back to earnings in a second. The next thing I want to look at is, and I'll come back to questions. John, I can see a question in there at the moment. Let's look at the employment rate. Employment rate has fallen. We can see it's gone down quarterly 0.6 percentage points. Payroll, in fact, sorry, I've missed one here. Payroll employees has dropped month on month by 85,000. Don't worry too much about this since Feb 2020, right? We have, with a big influx of asylum seekers, things like that. We've got more people than sort of 4 or 5 years ago. What's important is the employment rate per person, right? So the percentage of these people who are actually in employment. So we're dropped. Employment rate is dropping, not hugely, but the trend is down. Unemployment rate is rising, okay? Again, not drastically, but it is rising. And the inactivity rate is also rising. So actually, this unemployment rate is kind of slightly arbitrary because this covers people who are available to start work. I believe it's in the next 4 weeks. So not a massive section, right? The inactivity rate is people who are sort of off work long term, and that is going up as well and still going up. So we're seeing everything going in the wrong direction in terms of employment, right? So again, not huge, but statistically, everything's going in the wrong direction. But then we've got this discussion about earnings, right? And earnings are still high. So nominal earnings, actually, I don't know if you can see it on this graph. It's not very good and zoomed in, but it's ticked up a little bit in terms of our nominal earnings. So we're at, without bonuses, 6%. And when we look at real earnings, which is inflation adjusted, we're at 2% for earnings without bonuses. So we've got these two things, right? We've got, on the one hand, unemployment rising, employment dropping, vacancy rate dropping. On the other hand, people are still going, earnings are going up. Now, this is probably going to be the litmus. This is the benchmark, I feel, that the bank are using, is that earnings. They keep saying they don't want to be reducing interest rates until earnings are coming down. And they kind of stalled a little bit. But let's dig under the bonnet here. Because I feel, right, this earnings, nominal earnings, is going to have the same sort of theory as the OOH in terms of the lag for this. Because don't forget, people's wages don't just go up on a fluid basis. Not like every month people's wages are keeping pace, with these charts. You can have people who are on contracts and a year later they might have a pay review. And at that point it goes up, right? So we're probably seeing that lag effect of people over the last 12, 18 months having pay rises. Okay, and that's filtering in now. And don't forget, all of these figures are from January to March 24. So potentially, they're already out of date. So that's one thing I would say that we've got the same. We're probably lagging, or nominal earnings is a lagging indicator of where we are with the labour force. The other thing, it kind of got me thinking this morning as I was looking at this and researching this, is this concept of the vacancies, right? This concept of rather than companies just getting rid of everybody, they're not hiring, so people are naturally eroding from the top. But if people are not hiring, that means the labour force is going to be getting older, surely, on a sort of macro scale. And if the labour force is getting older and therefore people with higher wages are staying there, you're not bringing people in with the lower wages, right? The nominal earnings is going to be going up as well, because the way that they calculate this average weekly earning, right? This statistic, average weekly earning, is effectively taking everybody who's employed in the UK and dividing it by the gross amount of income they're getting, right? So it literally is that calculation. So it figures that if you're having an aging workforce, okay, and by older, probably generally you're going to be on a higher salary than somebody who's 19, 20 years old. the average weekly earnings are going to be going up. So is this another factor that's going into skewing this data? So number one, we've probably got a lagging indicator. Number two, if we've got an aging workforce, the average weekly earnings are going to be going up. I'm not saying that people are not getting pay rises. Of course they are. But the media's like, everybody's doing really well now. Everybody's getting all these high pay rises. But then you speak to people on the ground, right? And nobody's sort of sharing that sentiment. Everybody's still going, my God, affordability is an issue, right? Look how expensive food is. It's like, go out to shop and it's £100 for a couple of pizzas, or you go out for a meal and it's £300 for fish and chips, or, you can't get a hotel, without paying all this money. And, people are struggling. Don't forget, we've still got lots of people coming off cheap debt this year, kind of the final year, really, of those people who were fixing 2 years ago, or the final period. But the people who are fixing 5 years ago are also now coming off that. So you're getting a lot more people come on with affordability issues and rental issues. So basically younger generations, right, going into rental, or maybe they bought first houses and then coming off their cheap fixed rate debt, are really struggling with affordability. I feel a lot of this is skewed. So I think the damage is being done. I feel like there's a grinding of certain demographics in the UK right now. Anyway, to kind of tie this piece of analysis off, what I actually did, I'm going to have to see if I can zoom in. I actually went into the labour force survey because I wanted to see if there's any merit to this ageing population argument. Okay, so if I have a look at this now, I'm going to go into. Let me just play around with this so we can see it. Sorry, it's a slightly clunky what I've done here, but this plot, which I'm highlighting, is employment age 16, 17, right? So this line are people age 16, 17. So you can see COVID, massive spike down, went back up, but we are dropping, right? After that sort of peak of 21, 22, employment in that age group is definitely dropping, right? Let's have a look at the next age group. Don't want to be doing that, which is 17 to 18. So 17 to 18, we can see the employment. This is the employment percentage, by the way, of people in this age group dropping. Let's go to the next age group, which is 18 to 24. 18 to 24, is that the right one? Let's pick the same one. There we go. It still seems to pick the same one, is also dropping. 25 to 34, okay, is kind of, we can see it's dropping a little bit at the end there, less so than the others. 35 to 49 up here is pretty much stable, okay? So that's pretty much stable. 50 to 64, a little tiny drop. And then we look at age 65 plus down here, right? And actually that's consistently growing. People who are age 65 plus still in the workforce. So for me, that actually proves the point that we have an aging workforce right now. And I believe that is going to add a skew into the average weekly earnings. So why do I say all of this? The Bank of England are using probably average weekly earnings as their, oh my God, we need to take, they're stabilized or they're dropping, they're down to sort of 2%. Let's now take the interest rates down. They're still up at 6%. So I suspect when we get to the next meeting, they're going to be going, it's still too high. We're going to be leaving the interest rates, where we are. Is that the right thing for them to be doing? And is this data skewed? So my gut feeling, right, is we haven't hit target. It's not quite as low as people think, and the banks seem to be very reactionary to public sentiment, and the market seems to be very reactionary to this short-term data, which probably implies that we're probably not going to drop in June, and I would probably put the money on first drop in August. Let's see what happens with the election, right? Because now that's been called on potential. Well, it's not. I don't think it's actually been called, but it looks like they're talking about the 4th of July. How's that going to affect? Because we might have a general election before we get that MPC meeting in August. How's that going to affect it? Meanwhile, let's see what's going on in the property world. So we've had the ONS HPI, House Price Index, out. We've had a tick up for the first time for a while. So if we look at this rate of change on the UK ONS HPI, we're now annual in price growth. No surprise there. When you look at the other HPIs, if this lags 6 to 9 months, the others have seen the same. So this to me is not a surprise to see. We're just lagging the others. But yeah, this is the ONS data. Again, if you see monthly, we're now ticking up. This is March 24.7% rise. Okay, interesting. Is sentiment coming back? Don't forget, this is laggy. Let's look at Rightmove. Rightmove's latest HPI sees asking prices spike up. Everyone's like, oh, we've got record house prices. let's be realistic here, right? If we have a look at where the majority of the house price increase is coming, right? If we have a look at this, top of the ladder, right? So we've got first time buyers, monthly change 0.4%, second step is 0.2%, top of the ladder 1.6% month on month change. Don't forget, Rightmove is effectively listing price. So the majority of this increase is coming from top of the ladder properties. Now, sorry, you go out there and I'm not seeing loads of people running to buy super expensive houses at the top of the ladder, and a load of demand of people looking to buy expensive houses. So I do not buy for one moment that this is house price inflation. This for me is more expensive house prices coming on the market. Okay, this is people coming off their mortgages. This is people needing to sell their expensive house prices. I believe this is misleading data that is causing this. That's my gut feeling. I'm not saying that sentiment is not coming back, because people are now starting to look and see that there are going to be interest rate cuts coming, and people just want to buy property. But don't expect this market to sort of take off anytime soon. I think this is, in fact, let's just go back to that Rightmove and have a look. We're seeing, okay, if we look at price and activity trends. Okay, we're seeing more average stock per agents. We're seeing more properties come onto the market as we thought, from the sort of crunch we had last year. More stock coming on. Not everybody's going to be able to go out and buy all of these things, so more stock probably means more pressure on house prices. Saying that, right, it's taking less time to secure a buyer, so maybe the confidence is turning. It's difficult. We need to see some sort of more concrete trends with the actual sales data. But I would suspect, as I've said all of this year, that we're going to be sitting sort of, in actual sale prices, sort of stabilized, maybe slightly up, slightly down. It doesn't sort of matter too much in nominal terms this year. I can't see it crashing from here, but I can't see it going up anywhere. I think this is a very misleading chart, this asking price trend. Okay, extremely misleading. Don't forget, this is Rightmove, not the actual HPIs. I think a lot of people are changing their narrative. A lot of analysts change their narrative from drops this year to slight growth this year. So I was saying a couple of months ago, I said I expect vague stability with a skew slightly to the downside with more stock coming on the market. Other people are saying kind of level with skew to the upside. Maybe I could be convinced on that. I don't think we're going to be crashing down anytime soon. But let's wait and see what happens over the summer, because if summer comes and we don't get an interest rate cut, we could see a sort of reversal again with that. Don't forget, when we look at 2008, if you look at this financial crisis, this is percentage change annually, by the way. So massive drop down in the wake of the financial crisis, then a rebound, and actually we came down again for what was that, sort of 2010 to 2012, right? That sort of time period, two-year period. So just because we're coming up here does not mean we're going to carry on going to the races. Okay, something could happen that takes us back down, but I don't see us going deep into the red anytime soon. So that's the update from me, team. Let's see what the questions are. Hopefully that was a useful sort of aggregator of what's going on right now. John, the great crop. Let me just put this onto the broadcast. The great property price correction due to a serious rise in interest rates just hasn't happened, and it looks even more likely that it's passed. Yeah, look, I agree. We're not going to get this big reset, but we have, right? This is what I keep saying. We have had a massive reset in property. It's just in real value, not in nominal value. When we look at the inflation adjusted house prices, we're on a 20% plus correction. And actually, I know homeowners don't care about inflation adjusted. But investors should care about inflation adjusted, because you need to, assess your investments against other inflation adjusted investments, like gold, for example. So property has fared poorly over the last couple of years on a real term value. What hasn't fared poorly is rental income. We're seeing a return to yield, or stronger yield, for property investors, those who've held the nerve and hold. Rents have gone up. I think it's still worth noting that there's amazing deals out there all over the place, especially from a sort of investment point of view, entrepreneurial point of view. There's lots of landlords still exiting, pension funds exiting, institutions exiting. I'm not talking about residential sort of homeowners here. I'm talking about investment grade properties. Some great deals out there. I don't know much longer that will last for, right? If we do see a proper reversal. John's saying there's a lot of cash looking for bargains we experienced in 2009, 10. Yeah. So I've got to be honest, John. So I've deployed my cash. I started deploying my cash last year. We've bought 7 figures worth of property in the last 12 months. All cash, all very, very good deals. Because I talk about this quite a lot on the channel. Anything on a commercial valuation structure, I think we bottomed personally last year. And I know you don't want to catch a falling knife, but some real juicy deals when we look at that side of the market last year. There still are some juicy deals, but I'm seeing way more competition come back in to be buying stuff. So that's interesting. Let me put this one on. Speaking of Northern Ireland estate agent, he said the broker record amount of houses sold in Jan and Feb. He said he has to go back to 2006. Yeah, Northern Ireland is definitely its own little micro system. There's a massive lack of stock in Northern Ireland, and therefore supply demand curve is different to it is in the rest of UK. And a lot of the HPI house price inflation has come from there, right, from Northern Ireland, which I think is interesting. Even Joanne, how are you doing? Hopefully you're all right. SJT, let's have a look. SJT, oh, you're going to ask me a question about the general election now. I've not even had time to absorb it. Do you think the Tories have called the GE because they know the next 2 to 3 months are as good as it will get with inflation and don't want to get caught holding a GE if inflation goes up later? I think it's very astute, SJT. I like that. Yeah, because look, bankers already said, and they put out forecasts that they're expecting it to come down to target or just below target, then go back up again when the utilities inevitably rise. Although I'm seeing less talk of that right now, of the utilities coming, rising back up. I'm just interested to have a look where we are in. Let's just look at current gas price. I've not looked at it for a while. Let's have a quick look, see what's going on with it. Because don't forget, we forward buy gas. See if I can bring up it's kind of come up a little bit. Let's just zoom out. Just have a look. If I put this on, let's see where we are with gas. I use this as a very crude indicator because we do forward buy. So, obviously this is bizarrely where we were a couple of years ago. We spiked back up end of last year, but we're still sub what we're in at the moment, 83 in gas per therm. I don't think there's anything to, we actually fell down sub 60 in Feb, which is good. We've obviously got, a lowering right now, energy price cap lower. So we'll see how far this goes up. It's just definitely spiked up a little bit. We're having a little spike up at the moment, but nothing too worrying at the moment. We'll keep an eye on that trend. And the other one to have a look at, obviously, is Brent crude. See where we are with that. It's just, a lot of people. If I go over to Brent crude, we're talking about when end of last year, when the issue started happening in the Red Sea. A lot of people were talking about $120 a barrel again. Just hasn't materialized. When the latest conflict in the Middle East came around again, people talk about energy spike. It's just not happening, right? It's there's obviously enough supply now from other areas that are just catering. And let's not forget we've had a mild winter as well, so that demand over the winter has probably helped this out again. But we're just not spiking up. Everything looks stable to me. So I do feel, right, dare I say it, I do feel like there are some green shoots coming. Potential of interest rate cuts. That IMF report I read yesterday talked about potentially, 5 cuts in the UK, recommending 5 cuts in the UK by the end of next year. That's, what's that, 1.5%? 0.5%. Yeah, so 3.75 by the end of next year. That'd be a significant drop. The moment we see that trajectory, right, I've always said when interest rates start coming down, it's never about where they peak, it's about where they settle. I don't expect them to come down quickly. It's not going to be like every meeting. There's going to be a drop. But when you start to look at the data, so much conflicting data that's out in the mainstream media. Out of recession, yes. Back to some growth, yes. labour force wobbling, unemployment up, employment down. Look, I think they need to start bringing it down. The big thing to me is this cost of housing, right? It's housing crisis that these high interest rates are just fueling right now. It must be something they want to look at sorting out. There we go. That's my thoughts of where we are at the moment. Sorry, team, that I'm not live very much at the moment. I'm just so busy. We completed on a block of 7 flats last week, so I've just been busy getting that all set up. It's got tenants in it, but still got to have, it was an intense week or so getting it over the line before the MDR multiple dwelling relief ended, and we've got to do all the setup for that. I've got multiple coaching things, so I've actually got a coaching session this evening at 7 talking about SIPs and SAS investing. If anybody's interested in that sort of thing, these are the sort of coachings we do on Property Unicorn Club. There's a link to it in the description of this video. So I'm only really going live when we've got something to say at the moment. So let's follow this news with the election and see what happens when inevitably we're going to have a new government. That's my input for you today, team. I hope that's interesting and you're all well. I'll see you when we have something else to talk about. Have a good one.